I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout the show. Well, the stock market continued to surge last week. Well, that was until midweek, as all of the major indexes moved up to all-time highs. Focus remained on trade, as the president's hardline approach to that brings other countries to the table. The U.S. and Mexico, they came to an agreement. It's kind of a new NAFTA, as they're calling it, and that puts pressure on Canada. And the deadline here on Friday comes up for Canada to make an agreement with the U.S. Of course, they can extend that deadline, and we'll see whether or not the bad blood between Canada and the U.S. can be put aside and they come up with some kind of a deal. The president really ups the ante on China, as he says that $200 billion in new tariffs are coming potentially even in this week, so that hardline approach continues. There's lots I don't agree with that the president does, and I am truly a free market person. I don't think there should be any tariffs, honestly. But you got to give him credit for at least getting people to talk by putting this much pressure on them. The U.S. dollar has really strengthened this year, though the last couple of weeks it's seen a pullback that we think may be meaningful, but that advance this year has put big pressure on the emerging markets, and late in this week the emerging markets came under pressure again, especially their currencies as they moved down sharply. Turkey, Indonesia, they really had some problems at the end of the week, and Venezuela currency continues to crash, and that is a worthless currency. That's what you get when you have a socialistic society and all the corruption that they've had. And even Italy has really showing some problems in here, and that looks like there are at least rumors that they're discussing with Hungary about getting out of the euro. So it's just rumors right now, and Italy is certainly the worst of the markets in the UK, and when you look at their charts, the stock chart for their indexes, they are definitely the worst. And Turkey and Italy has a lot of problems, and we've just started to really hear it there, and we think we're going to get some more really bad news coming out of Italy. Investors around the world, they see the U.S. as the best place to be. They look past everything I just mentioned about trade wars or emerging markets or anything else, and only see positives coming out of emerging market difficulties or the trade chaos that we're seeing right now. And of course, when you only see the positives, well, my poker term would say everyone gets all in. And that's essentially what we're seeing here, as heaven forbid the fund managers should miss the 10th year of this bull market. We're coming up to 9 years of this bull market since that 6.6 low in the S&P 500 in 2009. And the NASDAQ leads the market up this week as analysts, specifically one analyst, upgrades Amazon, and that had a 65-point up day during the week, 3%, as the stock moves over 2,000. Now that puts it at 120 PE. Lagging PE is much bigger than that, so that's PE for projected earnings, and that is an exceptionally high valuation, whether it's fear of missing out or a euphoria situation that's driving investors into stocks. We've got some very high valuations here. If you think back to other bull market peaks, and let's just talk about a few of them. The S&P 500. Now, we've got some decent earnings growth in S&P right now because you give credit again to the president's policies, especially the changes in the tax plan. So that maybe just borrowing this year from next year, and that's yet to be seen. But the PE peaks in past bull markets. 2007, the S&P 500 peaked at 22. That's the PE. In 2000, which was the dot-com bubble, the extraordinary valuations that were in the NASDAQ with many 200 plus PEs in those stocks. Well, the NASDAQ was up around 80 PE. The S&P 500 peaked at 26 that year in 2000. Let's just talk about some other bad periods where markets peaked. The crash of 87 came with a PE of 18. That was at the bull market top. For 1962, which was a 27% crash, that came from a PE of 21 in the S&P 500. And if you want to think all the way back to the crash of 29, of course, valuations were measured a little differently then, but the PE in what would have been the S&P 500, of course it wasn't alive back then, was around 17, the PE for the market at that point. So the S&P 500 now, with things like Amazon going up and the stocks that have been really inflated over these 9 years, the S&P PE right now is 25. That's historic PE that we're looking at right now. And even with the policies benefiting growth and all that, it is historic. I mean, it's huge. And my thoughts, and I talked last week about being the skeptic that so far has been wrong, is that the 10th year of the bull market is going to be very hard to get. That's what I think. And I think these valuations are extraordinary. And as all of these investors get sucked in by a market that won't pull back, because the fear is it will never pull back, well, then the odds are pretty high that when it does come, it's going to be nasty. Let's take a look at what happened in the stock market this week as we look at the 60-minute chart of the S&P 500. And you can see that I prepare that during the week as I see different things come out during the week that may be some news that is significant. And you can see in here as we look at this chart that early on in the week, way down here on Monday, the Turkish lira fell 5%. Tesla dropped, as they said they're staying private. But then the market really barely flinched. You could see it right there as there was just a little bit of a downtick right there. And then the U.S. and Mexico announced that they were getting close to a deal, and Canada may join in at that point. You could see the market spiked right over there as that news came out. And then on Tuesday, the world markets moved higher on the U.S.-Mexico trade pact. But then the market gave ground during the day. And then, of course, as it seems to do a lot at the end of the day, it then firmed up because the shorts just can't stand holding any positions. So that happens. We get these early day rallies seemingly every day. The news came out on Wednesday. Home sales were really weak, down for the 7th month. And they're blaming that on low inventories right now, but it might be interest rates going up. It might be a consumer that doesn't really know whether it's safe to be spending money on anything like that. And of course, rental properties are much more in demand. Amazon gets this upgrade here on Wednesday, and 65-point gain, 3% plus on that. And that lifts the NASDAQ 90 points. As you can see, this was the big gainer here for the week on Wednesday. China stocks fall on Thursday overnight as the data showed that there's some risk of slowing going on in there. Now, the PMIs at the end of the week were a little bit better. Here's where on Thursday the president came out and he talked talked about the 200 billion in Chinese tariffs coming as soon as next week, and you could see that brought a sizable decline in the futures, 29.12 down to about 28.95. So that was about a 17-point intraday drop. That's pretty unusual these days, and well, towards the end of the week, things did get weaker. Here on Friday overnight, emerging markets were weak as the currencies really crack. Historic lows for the Indonesian rupiah and the Indian rupee. Now, the Indian stock market is one of the best stock markets that we see right now. And Turkish interest rates, we talked about they're going to have to keep raising rates to defend the lira, and they moved them up to 20%. So, and the Bank of Japan, this is maybe the biggest news of the week that nobody pays attention to. They made this little adjustment that they're going to do one fewer rounds of their QE per month. Now, they might adjust the amount that they buy up, and it might be just technical that they're doing, or it might be setting up the beginning of the end for their QE. And their QE, just like it did here in the U.S., simply keeps money in a liquidity trap. You cannot grow economies when the government is everything, and that's essentially what we have had, and why Bank of Japan for 3 decades has been doing this, thinking erroneously, as they are Keynesian brainwashed people, that they can keep doing that, and that's been their issue. They need to get out of the market, just like our Fed. I think we should get rid of all central banks, don't you? This is Friday, of course, and Canada and the U.S. still have no NAFTA deal, and it seems like they're pretty far apart. Ford came out and said they're going to cancel the plant that they were going to build in China, and the dollar jumped. And when that happened, sellers came back into the market. As you can see right over here, as the S&P 500 fell a quick 14 points or so intraday. And here we are just with a couple of hours left to go in the day, and the stock market is actually down for what is the second day in a row. And that in itself could be turning out to be something historic, as the stock market gives just a modest amount of ground. Right now, as we get into just this final hours of the day, the stock market is holding on to fractional gains on all the indexes after having rallied early in the week and then pulled back later in the week. Bonds, they're down about 3/4 of a point. They fell early in the week and then rallied later in the week. 10-year yields, they had been up as much as 6 basis points, but now dropping back, and they're up about 1 basis point on the week. The dollar, which fell earlier in the week, then rallied late in the week and is accelerating a little bit here on Friday. On all of this background news, gold down about $7 on the week. It hit our upside target in the short-term view. We're going to make some comments about today's improving relative strength in gold as we get into the short-term view in the last segment. Oil continued to gain. It's 2 weeks in a row. Last week was a huge surge, the previous week, and last week was up about $1.40 as that comes up and hits an area of resistance. So that's it for the opening segment for the week, and I'm going to be right back and bring you the best and worst stocks for the week. All right, now we come to the best stocks for the week. I analyze about a little over 300 stocks in my analytical universe. And those are stocks that are mostly in the high cap and mid cap. And then our focus list of stocks and ETFs and futures, we call that down to about 80 of the best traded stocks that we do weekly and daily analysis on. And that's what we share with our level 3 and level 4 subscribers, all of that analysis and a few different versions of the way that we do that. So what I'm going to bring you right now are the best few stocks, and because we don't have a lot of earnings reports coming out right now, there isn't anywhere near as many as we normally have when we look at these during the earnings period. So I only have about half a dozen in each of the best and worst stocks for the week. And these still give you a great picture of the type of analysis that we do. I'm a cycle analyst, which is looking at the rhythms of the market. It's a visual depiction of money flow, and it really gives through the different nuances the good feeling, a great connection with the market that you can have through this type of analysis. And if you want to learn it, you can go check out our cycle analysis workshop. It's 20 video modules. It took me 2 years to write, 6 months to produce, and it is absolutely amazing. And the people that have taken it keep watching those videos over and over. Some people tell me they've done it 3 times already. So you're going to learn so much about technical analysis and cycle analysis in that workshop. So I encourage you to go there. Here is the first one we're going to look at, and this is Pandora, up 13% on the week on strong subscriber growth. Now, I want you to note that, well, first of all, they lost 54 cents for the quarter. So this is not a stock with a lot of earnings in here that can give you any sense of real profitability. Now you can see in here that we have the downtrend and what we call negatively configured cycles. You can see where they started and where they ended. And on the bottom are the cycle brackets, which just are guides for timing to give us some sense around plus or minus a few weeks where the significant lows are likely to come. And the area where the peak comes, in other words, how close to the middle it comes or beyond the middle, is important information. So you notice that this one peaked only in the 5th week off the low and then broke down. That's really bad. The middle one was a base that got built there. It was kind of just a sideways and a slight upward bias to it. And then the next one was a really bullish pattern because, well, it translated on the right side. It rallied for some 3 months and then fell for only about 5 weeks. So that's a positive pattern, and it says the next one is going to get above that high, and you could see it did it right there. And you could say it's cycles, you could say it's background news, but essentially what happens is that a stock that's bullishly configured like this, when some little piece of news that is good will come out, then the stock really pops. If it were negative and some little bad piece of news came out, the stock would crack. So it uses the windows of opportunity to move in the direction of the directional component. In this case, it's up. You could see it was down and then curled up, and there's your uptrend right there. Our target in here is this target zone, and maybe around that 61.8 fib right at that point. The target zone or fib extension, 78.6 to 100. And so that's a really good way to target. We're looking for about 1070 on this stock on the upside. And it's all technical. I mean, the stock's, loses a ton of money, and the prospects of that changing in any significant way are small. So you're just, if you're investing in this one, you're investing in it technically. I mean, there's not much hope that they're going to be in good shape unless somebody comes in and grabs them, which of course is always a possibility when you have a, unique platform. And in this case, streaming music. Is it unique when you've got so many companies coming into that business, and Amazon and Apple, and there's just so many. And so I don't think this stock's going to get taken over. I just think that 10 plus in there is reasonable, and then giving it up after that would be my guess. So that's a little longer discussion in there about what we look at here. So Pandora up 13% on the week on that strong subscriber growth, which is not going to make a whole big difference in their earnings. Take a look at Ciena. Ciena is in the networking category with Cisco and Juniper. And you can see that jumped up past the 100% fib extension. This is almost the same story. You could see the negatively configured cycle here, and then the positive cycle right over there, which says you're going to achieve a high above $27.70. Well, there it is at $32. I mean, just a massive upside move. And you can see, well, we're concerned about valuations in here. And this one has got really a reasonably high PE, and we're concerned that this one is not going to make a lot more ground. We could see 33, 34 in here, and maybe another few weeks of advance, but usually when you have this kind of a move, you give it up, and you can see that when you look way back over here on March 5th, where it spiked up in this second little cycle there. Well, here we are right over here, right around similar area, and spiking up right over here, and that was basically the peak the second week. So with Sienna, earnings were really strong. Analysts upgrading it there, and 13% gain on the week. And I think it's silly to buy it here unless you're a long-term investor that can sit through, a 20% pullback in this stock. It just doesn't make sense to me. Lululemon is another one in a similar category. Now, we way back over here, when it was at the bottom, we saw this positive pattern in this support zone. We saw this diamond that it broke out of. All of those were positive occurrences. And you could see right over here in July, we were pointing to a spot where we thought there was a corrective bottom and then was going to rally again. So this is that declining area, and this is the rally area. And that's right over here. So it followed patterns perfectly. Forward PE on Lululemon in a retail clothing manufacturing category is absurd. So here we are. We're talking a lot about valuations, and that may be the story today, as I brought that in the opening comments, that valuations are nutty. And that people getting in at these levels are being sucked in because they kind of have to buy them. Lululemon up 12% with earnings strong, and just the valuations to me are a concern. Talk about valuations that are a concern. It's like I'm bringing you this common theme today, as the stock that we thought was riskiest for the year in that list of 14 stocks that we had has managed to more than double. So sometimes when we see high valuations and we see patterns that are suspicious, and we're wrong. I mean, you can see what's going on in here is their growth has been pretty decent. Their 18 earnings are expected to be about 45 cents. And that's actually a big upgrade on that. And their 19 earnings are expected to be around 79 cents. So with that, if they earn 79 cents, their PE is going to be at this level about 110, 120. Again, it's not making a lot of sense to me, but if you're a technician and you're looking at cyclical patterns, it's hard to deny the fact that this is positive, or it has been positive. Bullish, bullish, bullish. You can see that. This barely could decline and then moves up again. So everything about this has been positive. See what happens? It hits the support zone, explodes. Hits the support zone, explodes. This one I didn't put in there, but you could see it touch that 13-week moving average, which has been the support for this stock the whole way and continues to move up. So that's just a tremendous upside move. Now, I got to tell you, I shop a lot on Amazon, and I watch Amazon Prime, and Amazon has kind of been embedded in my life, our lives in here, and their growth has been really good. It took a long time for them to be able to earn money, and now they're earning money pretty significantly, and their earnings growth is extraordinary. I mean, you can't deny any of that. But now at these levels, with analysts coming out and upgrading the stock again, you really gotta wonder whether or not this isn't that a dot-com, a variation of the dot-com bubble that we had in 2000, because some of these PEs, as I've just shown you, are just out of sight. This chart we have a little bit different look at. We have our colored phasing in there, which shows you the positive phases and the corrective phases. And this is extraordinary when you have these little yellow corrective zone phases, and then the stock continues to rally for long periods of time. Each rally phase that you're looking at there has been 2.5 to 3 months, and each corrective phase has been between 2 and 4 weeks. That's an extraordinary upside move, is just in this picture that you're looking at right over here. As we go back a couple of years, the stock has moved up from 710 to over 2,000. So it was a big triple in here. And yep, this stock was on my riskiest list for the year also, but their earnings accelerated. They're going to earn, they estimated to earn 17.25 for this year, and there was a big upgrade for 2019 at 25.35, which I think is absolutely crazy. But even at those numbers, the PEs are just absolutely extraordinary. And one little sniff at a miss in here of a tiny little bit of less growth or anything like that, and this stock is going to get cratered. In the meantime, I'm a skeptic and cautious on a stock that I was cautious on a year ago. So, I haven't been right in this one, and the patterns are just screaming. This one, you could see the little stars in here. They tell you the cyclical lows right there, and that says that very shortly we're likely to go into another one of those 2 to 4 week corrections right there. And there's your support zone put in there, so that's pointing to about 1875 on the stock. So that would probably be in line with a NASDAQ correction were that to happen. And if you overlay the NASDAQ on these corrective areas right over here, go back and do that yourself. Put up a weekly chart, the weekly NASDAQ, do a comparison. You'll see that those are little periods where the NASDAQ had some corrections also. So that is a look at Amazon. We think that this one, which got an analyst upgrade, is up 5% on the week. And we think that one of those corrective periods is about to start. And overall, the pattern is massively bullish. I'm not going to deny that. I part of me is a pure technician and says, I see what I see, and that's what I tell you. And part of me is a realist or skeptic or sees other things that brings doubts in my mind. And that part of me has been wrong a lot this year. All right, so now let's take a look as we move over and put on the worst stock. All right, well, we put last week, we talked a lot about retail, and the previous week also, as they've been going pretty much in both directions. Some stocks that had pops pulled back pretty hard, and some of these stocks now are really disappointing, especially in the teen retail category. And Abercrombie was the worst stock of our stocks for this week, and that's down a whole 21%. ANF is that stock, and you're going to see now as we get into the worst of the week a lot of stocks that are looking to us like there's been damage done, major tops in place. So Abercrombie is a great example of how a bottom formed and how a top is forming, and how when the bottom forming it projected up nicely and it worked, and how the top is forming and it's really giving signals of danger. So that's what we're going to look at right over here. Here is Abercrombie earnings in line, revenues a little weaker, and in Europe sales falling, and analysts did not like that at all. Now this was on my riskiest also. I'm showing you interestingly, just coincidentally, there's some stocks that were on my riskiest list for the year, and this one actually has a chance to be down for the year, because you see that double top right over there? Well, that measurement points down to $14. Now it's in this declining phase right over there. You see that double top really says there's trouble right there. There were tweezers. That's a tweezer, those two high waves or tails that you see there, and that is suggestive of a major top. Once it breaks underneath this important level right over there, well, it's goodbye, and you should be moving down in a significant way. Now you see that pop right over there? You often get rallies in the fall on some of these retail stocks because, well, investors are anticipating Christmas sales. So we're likely to get into a choppy period, and we may not make that double top measurement until next year. So right now the decline looks like it goes into October, and then we get a bounce and then another wave on the downside. Note the saucer bottom right over here and the inverted head and shoulders and the beautiful breakout from that intermediate resistance zone, and that exploded up, the positive cycle patterns that occurred. So this is a great example, a bottom that formed, a top that formed, and we're looking for much lower prices in Abercrombie. We think that there will be attempts at rallies, and we think that will be opportunities to liquidate holdings in there in Abercrombie. We think it's a 21% down on the week. That really is just the beginning of it. So bad looking pattern in there. Let's stay in retail, and in the teen retail specifically. So this is American Eagle Outfitters. Now you can see in there some shorter patterns than some of the other stocks that we were looking at. Very clear cyclical patterns in there. What I do is I take the cycle brackets on the bottom, which align to where the significant low periods should be, and then I show the real trading by showing the cycles up around the actual price of the stock. And you could see that this is the ideal, but then when you put an upward directional component, this is how essentially they resolve themselves. This decline that we're in right now points to the end of a declining phase. So that should get you a bounce. But there's a big downside gap in here, that big evening star that formed, the gap on the daily chart, which I'm not showing you right now. So that creates a sell zone right in there. So we're looking for a rebound, and we've actually started to get a rebound in there. The earnings beat. Their guidance was weaker than expected. And Friday, the analysts came out just exactly at the right spot in that intermediate support, defending the stock. They think that, this is a buying opportunity. I think they're wrong, actually. And I think that it's a selling opportunity on this rebound in here, though it could kind of hang around in here for a month or so before it really starts to move to the downside. Bed Bath & Beyond, another one in retail that I think is important to look at, because it's building a base in here. Now you could see our projection. Now we put that in our stocks. This is the cycle patterns. You could see the green zones are rising, the yellow are corrective, and the red are when they get into negative patterns. Now when there's only a little bit left of time to go in the cycle pattern, the red is really small. When the breakdowns are early, the red is big, and there's a long time to decline. In this case, there was only 1 bar's worth of time right over there, and right now it's holding above that low in the base. If it breaks 1660, it's not going to have a good pattern anymore. So it's about a point above that important low. And right now it looks like it's the end of this decline. So with this decline, as analysts downgraded here, I think it's a buying opportunity. And I think we'll see Bed Bath & Beyond move up from here. It's reasonable to expect a test of 21.5, 4 points on the upside in this stock, which would be about a 20% gain. That's about what we're looking for, a little bit better than that over the near term right in here. The last stock in the retail category we're going to look at here is Best Buy. Now, Best Buy down 5% on the week. Their earnings were okay. They came out okay, but they were cautious about a sales downturn. And this is called a dark cloud cover right over there. It was down more for the week, and you could see this 34-week moving average has been just a monster. If it breaks below this low right over here, 73.50, and which is that 34-week moving average, it's over. And because of this looks like it's turned down already, we have it in a yellow zone and projecting down. However, it could still save itself, and we might have to revise that. But this is a stock that we have to turn cautious on, as they have also, and say that this really looks like a stock that is likely to give ground. Now, this forward PE in here is more like about 15 or 14, so it's not horrible in this. It's not like we're looking at a massively expensive stock, but we still do see the possibility of it getting down to breakout areas, which is about $65. If we do get this breakdown here below this, we'll call it 73.50 or so. And it's a long way from there right now. I tried to get there this week and held up. So that's a look at Best Buy. The next stock we're going to look at is in the restaurant area, Chipotle. Now, Chipotle had a lot of problems over the last couple of years where they had people getting sick and the customers really lost confidence in them, and then they had other issues with not being able to get product, and that really had the stock giving a lot of ground. And then we saw the bottom form in there in Chipotle, and we thought it was going to be moving up, and it did, and it moved up sharply and got to our targets and beyond in there. Now this week there's some bad news, and let's just take a look here as we switch over to CMG, which is Chipotle. And I can tell you a little bit of this story in here on the patterns, as we had a pretty interesting megaphone bottom that formed in there. You could see down there in the megaphone, you can see the cycles. Now in this case, these are called cyclical harmonic families because you have essentially a major and a minor right in there, and the timing on them is just fantastic. So you had this low low come right on time over here at 247. That was after the stock was much, much higher. And then it started to form these positive patterns. But look right over here. You've got this evening star that has now formed. The Pershing Square has been a big holder of this stock. They just sold off 2% of their holdings, moving it down. I'm sorry, 20% of their holdings. I don't hold me on that. I'm not exactly sure of the number. I had it, and now it's not on my notes. But they've lowered their stake to 7.4%, and they could be planning to sell more. We don't really know, and that's why the stock has got this pattern right in here. I think it's a top. At least a short-term top. We'd be looking for, you see it got down to the 13-week moving average right here and right here. Well, we're going to be looking for it to get below or to the support area, maybe the 78.6%. So we think that this is significant. When you get a major holder like that starting to liquidate stock, that usually is something important. The last stock I'm going to show you, and the worst for the week, is Seagate, STX. We were bearish on this stock. We saw this head and shoulders top forming in here. Here's the head and shoulders measurement. We said this rally is likely to be wrong and then fail, and you could see it moving down right now. Our target for this is down here at around the $48 number. We think it's going to get there by late September, beginning of October. And one of the pieces of news that came out in here is that there is insider selling. So that's insider selling may be meaningful. We don't really know. It could be technical, but does have holders nervous this week. And the head and shoulders top is real and completed, and likely based on cycle patterns to move down into late September, beginning of October. So it's not a stock that we would want to be holding right over here. As a matter of fact, it's a stock that we would want to be biasing on the short side. That is the worst for the week. And I'll be right back and bring you our short-term view for the coming week. All right, short-term view for the coming week. We're going to look at daily charts. Before we get to that, follow me on Twitter at askSlim. We do put tweets out there with our articles every single day where we highlight specific stocks. You can become a YouTube subscriber, and don't forget, give us a thumbs up, and that helps us with our standings with YouTube. And also, if you give us a thumbs down, there's too many people that, well, there's like 2 or 3 people that give us thumbs downs, I think, and they don't tell us why. So just give us an idea. Maybe you just don't like my face. Well, that's a good enough reason if that's what it is, but tell me about it. So also I want you to go to the website to askSlim.com and take a look at all of our memberships. And if you're interested in a trial membership, just write me at slim@askSlim.com. All right, for the short-term view, we look at daily charts, as I said, and then I take an accounting of what I say every week. What I really do is rank myself in 3 different ways. What I do is I analyze based on the shorter term cycle patterns. So the rhythms of the market are there. It's how well I can see them and then bring that information to you. So it's about the shape of patterns. That's number 1. Number 2 is the price levels, where I think it's going to rally to or fall off to. So those support and resistances, and how valid were those. And also, did it finish up or down based on what I thought would happen during that coming 5-day period. Sometimes we're looking at a little further, so I'm a little hard on myself. But I still want to keep it in this 5-day window of time periods. For this last week, we were around 60%. We try to be 60-65%, and it's 2 to 1, right versus wrong, and that's what we'd like to be or better. So, 2 weeks ago we were 35%, and that's going to happen to us now and then. And we had a few weeks in a row where we were 80 and 90% correct, which is rare. So let's look now, light crude and the dollar, and we did really well. The dollar, we were spot on in there, and also gold, we were very close. Where we missed was the level was right and the pattern was right, but we thought it would be small down, and it actually was. We thought it would be small up, and it was actually small down on the week, just barely. So we didn't get that right. The bond market, we got only about 1/3 of the three correct, and the stock market pretty much the same way. We thought it would be kind of up for the week, but we thought it would fall early and hit a support and then rally. It didn't do that at all, so we were way off on the patterns in there. So now let's take a look to see what we think is going to happen for the coming week. I love this light crude chart. If you're a light crude trader, you know what I want is I'd like you to write me and say, yeah, I follow that particular market, so keep that in the analysis. In this case, this is light crude, and you can see the daily chart in there, and each of these yellow zones were the corrective ones, and we had talked about this decline coming in right there, and it was really perfect. And you can see it's very spot on with the cycles. Ran a little long, so we put a note in there that it was shifting a little bit to the right. Cycles shift, and you can learn about how to shift them, or how to see that if you take the cycle workshop. And we thought it would rally into this resistance zone. That zone 69.80 to 710 was the area we thought it would stop at. It's now at 70 even, 69.80 to 70.10, and it's now at 70 even. We thought it would then begin to roll over. It really hasn't started to roll over quite yet. This is one of those examples where the cycle points to a few more days in here. So we're going to look for down a little bit early in the week, maybe testing that area of 69 right over there, and then rallying again. Because it's down up, it's really a small change week likely in the next 5 days. And note the momentum is up. You can see that green arrow right over there. That green arrow is a signal from the slim ribbon. And now sometimes when the slim ribbon is really close, like over here, you get choppy readings, but then when it opens up wide, you get really strong readings. And this is starting to open up wide and telling you that momentum is strengthening in the light crude market, at least on a short-term basis. So we're going to look for a test of that 23.6% right there at around 69, and then moving up again. I would call that a short-term bullish scenario, as we're looking for, but only looking for a small change on the week. The dollar, we're going to look at DXY, which is getting a boost here on Friday. Well, look at that gorgeous pattern and how spot on it is. Comes down and tests that 89-day moving average right there. Now, I want you to see this note here, 831. That's to our subscribers, and now to you. The depth of this drop from there, 97 down here to about 94.40, is a lot. It gives up about 80, 88, 90% of this whole last rally. That's bad. It signals an intermediate top is in place, and therefore we think this rally is going to fail. So right now we expect that, first of all, note 3 days ago momentum turned negative in there. When you have a negative momentum and a projection oscillator up here at 100, up over that area on the bottom, the probabilities of further advance for very long are small. You could go for another few days, couple days, but then it's likely to be turning down again. So we don't think this rally is going very far. Our upside projection right over there, you can see, is around 95, we'll call it 95.50 right over there, to about 90, yeah, a little bit higher, 95.73 or 4. So 95.50, 95.7, that's really where we think the sell zone is in there, and that's where it's likely to rally to. We're going to call it a small up week, that it's going to be able to get up into that area, maybe pull back a little bit again. And that momentum having turned down over here is really an issue for it. And all of this is signal to us that we have an intermediate top that's in place, and the dollar is likely to be weaker moving forward. And that is probably going to start to have investors thinking about flow of funds, and do they want funds in the rest of the world coming into the U.S. at these levels. So, this is the very early stages of that. The euro, we thought what it would do would be to rally to that resistance and then roll over, and you could see, well, that was spot on. And the momentum in there has it strengthening. So you have positive momentum strengthening, the projection oscillator down at the bottom over here, which says you're not going to go down much more. And you could see the support area right over there. So we're going to look for getting down into the support, a little attempt at a rally, a very small week, maybe a little bit to the downside. Could test 115.40 right in the middle over there. And just really we think it's going to be a relatively small week. Now, the Italy-Hungary issues, those are big. And if that really starts to heat up, this could get uglier. And you can see in here that we don't really have a upward projection here going forward. So there's a discrepancy here because this is 56% weighting of the dollar index. So if we're not positive in here and we're not positive in the dollar, well, something's wrong. And we're going to figure that out as we move forward. So we're always alert for when correlations are in line or when something is out of line. And right now my analysis on the correlations between the dollar and the euro on the near term are somehow out of line. So we're looking at the cycle patterns, and one of these is going to correct. And I'm wondering if it's not the euro that is actually going to strengthen a little more and the dollar going to weaken a little more. We're going to see how that shapes up pretty soon. The gold market /GC, you can see that right over here. That gets, we talked about it getting up into the 1221 to 33 area. Well, there's 1221, so it was, right on the number. And then started to back off, and you could see the minor support in here. And we think it's going to be stuck in a range. We're going to call the bottom of the support area. This is 1186. This is 1194. We think 1194 is probably going to be what's going to hold it on the downside. And then that 1221 area right there really looks like, for now, it's going to hold it on the upside. That looks like tight range to us coming up here, and we don't think that there's big moves in the dollar or the euro in the next week either. So this we think is going to be a calmer week in the currencies and the gold market. And then really looking out over here into late, third, fourth week of September is where we see the gold market having the potential for a big upside move. So if we can chop around there and hold on, this minor support area is likely to turn into a buy zone, and we're going to watch for that. So we think ultimately traders are going to be benefited by thinking about the long side in here. Relative strength is improving in here to the dollar. Now, here we see gold up $3 on the day on Friday, with the dollar significantly higher. This is unusual, and it is showing strength in the gold market. So that's why we don't think there's a whole lot of downside in there. And if anything, we think the risk is that it's going to break out on the upside earlier than we anticipate, and this upward trend is going to extend, and the shape of this pattern is going to change to something more positive. So we're going to look for a range in there this week, but overall, I think the chances of the upside are better. Here we are looking in here at the bond market, and there is just beautiful patterns right in here. You can see the small patterns, the minor ones on the bottom, and the bigger dominant ones. There are three small ones that are very clear. We were looking for this decline to come right in here in the bond market and then move up again. We thought it would be small up and it would chop its way up. We didn't realize that these 2 days would be down as sharp as they were. So that's why we only get very small credit for the bond market. Followed pattern beautifully. And now we think in here that we're going to start to see a test of that high right over there. This high was 45.21 way back here in July. This high was 45.07. We think we're going to get somewhere in between those, getting up above that 45.07 area. In there in the bond market. Momentum in there on the plus side, and you could see momentum on the plus side, projection oscillator on the bottom getting oversold, and that brought the rally that we got right over there, and that is just the greatest combination of pairs. Please watch my video that talks about Slim's favorite trading pair, which is the slim ribbon and the projection oscillator. You can see that video in our level 2. You want to become a level 2 member. Again, you can ask me for a trial in there. We have 300 plus videos in there. You're going to learn so much about 8 different categories of being a trader, and one of them is technical analysis tools for techs. And we talk about this important analytical pair of tools that you'll just learn a ton from. So take a look for a month, and you can do all the watching you want of all the videos. And you don't like it, just unsubscribe. It's fine. The next thing we're going to look at is the stock market. So we thought the stock market would dip and then rally, and it rallied and then dipped. So that was a poor job by us interpreting the rhythms of the market. That's what we do, and we're always trying to project out. Every piece of analysis we do has got a projection on it, because cycle analysis is time and price. So we're always hoping to be able to do the best that we can, like 60 or 70% correct on those projections. And we do great on the longer term ones. The shorter term ones are harder. They really are. Take a look at the S&P 500, and I've added one little piece of analysis in there, and I explained that to our members, and that is the that green cycle bracket on the bottom. I had checked in with Arvi. Arvi is my assistant cycle analyst, and he's fantastic. So we check in with each other, and you see this green right over there. That's the rhythm of the market that he saw in there. And the blue one is the rhythm in the market that I saw in a dominant and minor pattern right there. So this is the minor one that he saw. And you could see it's actually following his pattern pretty well right there, but it's not far off of mine either. There's a variance in bottoms in here, which essentially is between September 11th and as far out over here as September 21st. So that's a pretty wide variance. Somewhere in here we're going to see which of these patterns is correct, but we're in this period where I said the risk is likely to increase. I told you back a couple of weeks ago that, I thought the market had topped. It was, there's not a lot more to go on the upside in here. Minor percent versus a lot of downside risk. Well, it did manage to eke out another percent or a little more on the upside in there. And now you can see that it's really starting to look like it's getting heavy. But it's a long way from any trouble. You can see the rising support in here. We're going to call for it to get into that support zone this week. This is 28.73 is the top of the support zone. The middle of it right over there is 28.60. So that is our best, most bullish projection that we could make right now on this pattern, is falling into that zone right over there this week. And then we'll see timing-wise how that works out. If it does fall into this zone and does not get below this 28.46 area, then it just continues this bullish upward trend. Whether it be the green cycle or whether it be the blue cycle, they're both bullish. Momentum strong, rock solid. It turns strong way over here at 27.67. And rallies up 125 points after that. So everything in here is bullish. You can see in here the projection oscillator getting down to the area of being oversold while this is positive. There's a few other occurrences that you could see that right over here. So the positive momentum is during this whole period right over here. Oversold, rally. Oversold, rally. And now getting oversold. So that says the market is going to fight any kind of a decline. Maybe you get another rally in here and then it rolls over like that. So we're not sure of the shape, but we talked about it a lot during these last couple of weeks, that the technical situation in the markets, and there is on the left is the weekly patterns that we look at. The technical situation in the stock market has been rock solid. Our market condition indicator trading up with the highest level, it could be 100, different indexes between 95 and 100, and the slim ribbon being in positive momentum. All of the weekly momentum indicators are all positive. You could see those on the stock index report, which are included with all of our memberships, and it's very clear when you look at that the technicals have been great. And if there's any tiny little things in there that you could make negatives of, it's the financials that have been laggards potentially, and of course the valuations, which are unbelievable. Told you that about that in the beginning of the show. If you're one of those people that likes to skip over what I say early on and just see this last section right over here, now go back and watch that, because I talk about PEs at bull market peaks, and I think that's pretty significant based on where we are right now. That is the show. Man, I had fun doing that today. I hope you had fun listening to me. And that's it. Make sure you write me, slim@askSlim.com, and I'll send you those links for the trial memberships. I want you to be really careful. It is so crazy out there. We're always wishing you great trading.
Well, I'm going to the city and I'm going to do a slimmage.